member on the Science Committee, Mr. Lucas.
Thank you, Mr. Chairman. Today's hearing is an opportunity to have a constructive dialogue on the issue of climate risk in the financial system. We know that the climate's changing and that global industrial activity has played a role in this. Further, I believe my friends on the other side of the aisle would agree that Congress and the regulators still have much to learn about the implications of climate change in the financial system. However, the argument that we are in a race against a ticking climate doomsday clock is counterproductive to achieving real progress on this issue. The United States has already made progress in science and innovation needed for cleaner energy production. Weaponizing the financial regulators to drive capital away from fossil fuels, still the most reliable and essential form of energy in the United States, would have dire consequences for the economy and U.S. competitiveness abroad. Instead, we need a more thoughtful approach based on the current state of climate risk assessment tools. Mr. Rossi, the electric power grid is absolutely essential to the U.S. economy and generating energy needed for businesses and families across the country. In 2020, fossil fuels were the largest source of U.S. electricity generation at about 60%. Nuclear energy was the source of roughly 20%. So, Dr. Rossi, could you speak to the potential consequences to the U.S. economy if we see a rapid government-driven disinvestment away from fossil fuels and nuclear energy?
Yeah, in the near term, we could see several things. So first of all, let me give you some perspective. These are numbers. I've been looking at the Citigroup recently, or a little while ago, had released their climate financial disclosure for this year. And in there, it was very interesting. One of the things that they flagged was their oil and gas exposure. And something in the order of like $50+ billion or so. Pretty sizable, but only about 6 or 7% of their overall exposure. Why that's important is because imagine now if you have multiple banks, just like what happened during the liquidity coverage ratio implementation several years back, when banks were looking at trying to measure how much liquidity they had on their balance sheet from a regulatory requirement standpoint, and found that some of those largest banks were certainly were not in compliance. And what would they do? They'd have to then rotate out of some of their lesser high quality assets into higher quality assets. So they would have to sell mortgage-backed securities in order to try and comply by buying U.S. Treasuries. Well, in this case, divesting from oil and gas investments would actually have a further amplifying effect, downward movement effect, that is, for some time period, which would actually cause those prices of oil and gas to go down, those securities, and in addition would temporarily anyway, would have impose some harm to the balance sheets of these banks. Now, I'm not saying it's crushing by any sense. They're well capitalized, so that's not going to be an issue. But from a knock-on effect standpoint, we're talking about impacts associated with a lack of investment if banks aren't lending again to oil and gas companies, their inability to do the kind of exploration that's needed to continue to provide us with the supply necessary to have heating and having to fuel our cars and that sort of thing. So it would have adjacent effects on increasing prices to consumers for things like utility bills, things for prices at the gas pump, etc. And so certainly would have adverse consequences in the near term for that.
Continuing with you, Dr. Rossi, you explained in your written testimony how climate credit default swaps could be utilized as a risk mitigation tool for the climate-related events. Could you discuss further how this financial tool could be used?
Sure. So the idea here is simply, and I think one of the other witnesses mentioned the use of financial derivatives by financial institutions. And during the financial crisis, I think Warren Buffett famously said something that these were weapons of financial mass destruction or something to that effect. Actually, derivatives are an important risk mitigation tool that are used extensively in the industry for things like transferring credit risk to private investors, such as what's going on with the government-sponsored enterprises, Fannie and Freddie, in transferring credit risk off their balance sheets and on to other private investors. In the case here, we're talking about, we've had for many years weather derivatives, rainfall derivatives, and we've had temperature derivatives that have not really kind of taken off much in the industry. But as climate change accelerates and continues to evolve, we need to think about developing credit or climate-related derivative tools that could remove that risk off these balance sheets. You can imagine, right? So that both Fannie and Freddie, for example, that are engaged heavily in credit risk transfer of their securities or of their mortgage losses, that is, are exposed increasingly, potentially, to more hurricanes and flooding events if and when that occurs from climate change. So being able to transfer that off directly by way of, let's say, a climate derivative instrument, just like a CDS or a credit default swap, where there's a buyer and seller in that market for that, a bank or a GSE could, for that matter, could buy protection from a seller on the other side, and that's how that climate derivative could actually function.
Thank you, Dr.
Mr.
Rossi.
Chairman.
The gentleman's time has expired.